Hello everyone. This video is on chapter 2, Basic Accounting Concepts in the book Financial Accounting. I am going to start this video with an example. So let's say that you received $100 from some event. Would it make a difference what the event was? To you personally, it may not make a difference. You just receive $100 and you're happy. But from the accounting point of view, should this $100 be recorded? And what difference does the event makes? Let's see. So let's say that you received $100 on your birthday. That will be recorded in accounting books as a gift. Let's say you worked part-time at the ice cream store and you received $100. In that case, it will be your earnings. It will be recorded as earnings. In the third scenario, you sold your watch on Amazon and you received $100. So you sold an asset, your watch, and you received another asset in form of cash. So you gave up one tangible asset and you received cash value. In the last scenario, you borrowed as a loan $100. So your cash increased by $100, but your liability also increased on your books because you borrowed it and you have a liability to pay it in the near future. So your liability will be increased and your cash will also be increased by $100. Next, I'm going to talk about the elements of accounting system. The accounting is used to produce financial statements. That's the main purpose of accounting. That it produces financial statement for external users and internal users. The external users can be banks, creditors, shareholders, and internal users can be the managers who run the company or the employees who work for the company. And the basic financial statements are income statement, balance sheet, statement of retained earnings, and statement of cash flows. Income statement gives you the net income or net loss for the accounting period. So it gives you the picture of the gain and the net income and net loss from the operations, from the activities of the business. Balance sheet gives you the snapshot of the financial condition of the company as of a specific date, and it is based on the format of the accounting equation, which is assets equal liabilities plus stockholder equity. So on one side it will show all the assets of the company, and on the other side it will show the liabilities and stockholder equity. And statement of retained earnings is the report that shows the retained earnings since the beginning of the company. Whatever was retained from the income goes into this statement. Fourth one is the statement of cash flow. So it shows the flow of cash into various activities of the company. And the three main activities of the company are operating activities, investing activities, and financial activities. And this statement shows how the cash was flowing in and out in these three specific activities. And the bottom line of this statement of cash flow is the net cash. And there is actually this is actually a checking point of comparing this cash to the cash amount, the ending balance of the cash amount on the balance sheet, and it should always match. If it doesn't match, it means there is an accounting error. So this statement of cash flow is like a checkpoint to see that the accounting was done accurately. So these financial statements are prepared with some set of accounting rules, framework, and controls. Let's understand them briefly. So first we'll talk about the rules. There are some set of rules that determine what, when, and the amount that should be recorded for an entity's economic events, and they are derived from 8 concepts. The list is as follows: business entity, cost, going concern, matching, objectivity, unit of measure, adequate disclosure, accounting period concepts. Now these 8 concepts are discussed in, I think, the first video, which is chapter 1. I have discussed that these concepts in detail in that video, so you can go and view that video one more time. Talking about the framework. In order to prepare the financial statements, the transactions must be analyzed. Analyze means that do they have economic impact on the company or not? And then they should, if they have the economic contact, they should be recorded, they should be summarized, and they using a framework. So everything, the analysis, recording, and the summary of the transactions is done using a specific framework. So what is a transaction? Transaction is any economic event that under GAAP means the generally accepted accounting principles, that under GAAP affects one, two, or more elements of financial statements, and therefore they must be recorded. Let's do an example. For example, your company purchased a computer for cash for $2,000. So you paid cash and you got the computer. Computer is the asset for the company. So because you purchased a computer and you paid cash, so one of the asset is going up and one asset is going down. Let me show you how it will look in the recording. So I would say that so first column is account, and then I have put debit and credit. Debit means and this is the T. So debit means the left side of the T and credit means the right side of the T. So in the first example, you purchased a computer, which is an asset, and the asset went up, right? So you will say computer 2,000, the value of the computer is 2,000, and then your cash went down because you paid cash. So cash we will credit because the asset account decreases on the credit side and the asset account increases on the debit side. So and we entered the debit entry first. That's a rule for recording these transactions, that the debit entry is always entered first. Okay, so we increase the computer by doing a debit entry, and we decreased cash by doing a credit entry. Okay. Now let's say that in the second example, you purchased a computer for credit. So that's, you again got an asset computer, but this time you didn't pay cash. You increased your liability. You still have to pay the cash in near future, but you will record a liability. So let's see how this transaction will be entered. So your liability increased, and the liability increases on the credit side. And your asset also increased because you bought a computer, you bought an asset, and the asset increases on the debit side. So which element has the debit entry? It's your asset, your computer. So we will do computer first. We will enter 2000 here because this time your asset increased by 2000 and the asset increases on the debit side. So we enter the debit entry first, but this time you didn't pay cash, so you actually incurred a liability. So the account used for that is accounts payable, and it will be a credit entry because the liability increases on the credit side, and this time you have increased your liability, right? And you will see that when I write these transactions, the credit side is little indented, the description is little indented. This is the way it's always done to just show that that's a credit entry. Okay. So the starting point for framework is the accounting equation. Accounting equation is assets equal liabilities plus stockholders' equity. The accounting equation is similar to the format on the balance sheet. The accounting equation will always remain in balance if a double entry system of accounting is followed accurately. So here, this is actually the double entry system. We are doing two entries, one debit entry and one credit entry. So the accounting equation will always remain in balance if the double entry system of accounting is followed accurately. So let's look at the accounting equation. The simple version is assets equal liabilities plus equity. Now, if the company is a proprietorship, how will this accounting equation be written in the expanded form? There is asset equal liabilities plus equity is the small version, but this equation can be expanded. So we will see the expanded version first for the proprietorship. Assets equal liabilities plus owner's capital, means the investment of the owner, plus revenues minus expenses. Revenues and expenses, they come from the income statement, minus owner's withdrawals, whatever the owner took out from the company. Okay, again, assets equal liabilities plus owner's capital plus revenues minus expenses minus owner's withdrawals. Now let's look at the expanded version of the accounting equation for a corporation. Here, assets equal liabilities plus paid in capital, means the investments of the shareholders who are issued the stock, plus revenues minus expenses, that comes from the income statement, minus dividends. Dividends is the dividends that are distributed to the shareholders, and minus treasury stock. Again, assets equal liabilities plus paid in capital plus revenue minus expenses minus dividends minus treasury stock. So the only thing that is adding value to the equity is paid in capital and revenue, and the rest, expenses, dividend, treasury stock, they are reducing the equity. Okay. Now this next slide is the overview of the account types. There are 5 account types: assets, liability, equity, revenue, which also means income, and expenses. To fully understand how to post transactions and read the financial reports, you must understand these account types. So first one is assets. What are assets? Assets are tangible and intangible items that the company owns that have value. Example is cash, computer, patents, buildings. It could be land. It could be a truck. So all those are assets to the company. Liabilities. Liability is the money that the company owes to others. Others can be banks, others can be the local creditors, others can be wherever you get the money from. So you're all your creditors. So for the mortgages, for the loans, etc. Your vendors, right? So equity account. Equity is that portion of the total assets that the owners or stockholders of the company fully own. Okay, so the accounting equation is asset equal liability plus stockholder equity. We can rewrite this equation as stockholder equity is equal to assets minus liability. So whatever is left after paying the liability is stockholders equity. Okay. Revenue or income. That is the money that the company earns from its sales of product or services and interest and dividends earned from marketable securities. Expenses. Money that the company spends to produce goods and services that it sells. Example, office supplies, utilities, advertising, rent. Okay. Now let's talk about debit and credits. In the beginning, there is always a confusion among the students about this debit and credit. It's hard to grasp this concept. So I have made a separate video for debit and credit, and I have explained that in the video with examples. So go check that video out. And here, this is just a review of that video, just a little summary. Definition of debit and credits. Debit means left side of a T account. Left side of a T account. So this is a T account that is used to do the accounting, to do the double entry system. So the left side of the T account is debit and the right side of the T account is credit. Debit and credit are part of double entry accounting system, which results in every business transaction affecting at least two accounts. So each transaction affects at least two accounts. At least one of the account will receive a debit entry and at least one other account will receive a credit entry. And the debit and credit should always be equal. Okay. Accountants often use T accounts to visualize the debit and credit effects on account balances. Think of a debit as an entry on the left side of the account and the credit as the entry on the right side of the account. It may take some time to learn which general ledger accounts will be debited and which general ledger accounts will be credited. So meaning that some of the accounts will increase on the debit side and some of the accounts will increase on the credit side. And please note that in the video that is I have made separately for debit and credit, I have also given a mnemonic to remember which accounts will have a debit entry and which accounts will have a credit entry. But there are some general rules, so let's watch them. Expense accounts generally have debit entries and have debit balances. Revenue accounts generally have credit entries and credit balances. Assets generally have both debit and credit entries but usually have debit balances. Liabilities generally have debit and credit entries but usually have credit balances. Stockholders' equity accounts could have debit and credit entries, but profitable companies usually have credit balances. So let's look at the accounting equation one more time. Asset equal liability plus stockholder equity. The asset accounts the asset accounts have debit balances, means all increases go on debit side, and all the decreases go on credit side. Now to balance the equation, the accounts that are on the opposite side of the equal sign, they have opposite increases and decreases. You see that the asset account increases on the debit side. So where will the liabilities and stockholders equity increase? They will increase on credit side. Both liabilities and stockholder equity, they increase on the credit side. Assets increase on debit side, and credits and liabilities and stockholder equity, they increase on the credit side. Assets decrease on the credit side, and liabilities and stockholders equity, they decrease on the debit side. Okay. So now let's look at the account. What is an account? An account is a record in which the amounts from a company's transactions are posted or recorded in order to sort and store similar amounts. Following are the typical account titles. Let's look at this Excel. I have the balance sheet accounts and the income statement accounts. Let's look at the balance sheet accounts, assets, liabilities, and stockholders' equity first. First comes the asset. Examples are cash, accounts receivable, prepaid insurance, marketable securities, land, building, truck, computer, etc. This list can be as long as detailed you want the accounts to be. Then liabilities are like accounts payable, interest payable, notes payable, bonds payable. There can be limitless liabilities depending on the company. Equity account is capital, stock, retained earnings, and dividend distributed. They go in the equity account. So these are the balance sheet accounts. Balance sheet accounts are permanent accounts. Okay. Now let's look at the income statement account. Income statement accounts are revenues and expenses. Revenues can be sales revenue, service fees, interest income, any kind of income goes under revenue. Expenses can be rent expense, salaries expense, interest expense, office supplies expense. This list can be as detailed as the accountant wants. Now please note that the income statement accounts are temporary accounts. What does it mean? That all these accounts are closed, zeroed out at the end of the accounting period. And by zeroing out means that their balances, they are transferred into the equity account of the balance sheet, because balance sheet accounts are temporary accounts and income statement accounts are temporary accounts. Balance sheet accounts are permanent accounts. Sorry. So the income statement accounts are closed to the balance sheet. Again, this next slide is a review of where the debit and the credit entries go, for asset accounts, which are on the left side of the equation, will usually have their balances on the left side of the account. Left means debit. So left means debit. And liability account, which appears on the right side of the accounting equation, will usually have their balances on the right side, which is the credit side. So credit means right side. Okay. So they will have all their increases on the right side. Equity accounts, which also appear on the right side of the accounting equation, will usually have their balances on the right side. Since credit means right side, an equity account will likely to have credit balances, means all the increases in the liability and equity account will go on the credit side, and all the increases on the asset account will go on the debit side. Now, the expense accounts are also close to the equity account. The expense reduces the equity, that's why it has the debit balance. Means all the expenses will increase on the debit side. Now let's look at some examples. Example number 1, the owner invests capital in the company. So the owner gives money to the company. What happens to the cash? The cash increases, and the cash increases on the debit side. And we will record this investment in owner's equity also. So, and the owner's equity increases on the credit side. So our debit and credit entry will be debit cash, means increase cash by 5,000, and increase owner's equity by 5,000 on the credit side. Example number 2, the company borrows 8,000 from bank. Let's analyze this. Since the money will be deposited into the checking account of the company, the cash will be debited because we have received the cash from the bank. So our cash has increased by 8,000. The amount to receive the credit entry is the liability account called loans payable. You may create a separate account or a sub-account for each kind of loan. Liabilities increase on the credit side, so crediting a liability account increases its value. So we will increase our liability by 8,000, and the account actually that we are going to use is loans payable. Okay, so this is for credit. Okay. Now this is the example of the debits. The next 2 slides are just the summary of the chapter 2, but these points are very, very important. It's important to remember each one of them. So let's have a look. Number 1, a balance sheet reflects the accounting equation. Assets equal liabilities plus equity. 2 sides of the balance sheet, the accounting equation, must always be equal. Every transaction affects, means increases or decreases, one or more of balance sheet elements. So every transaction that happens, it must increase or decrease one of the balance sheet elements. So it affects one of the balance sheet elements: assets, liabilities, and stockholders' equity. A transaction may or may not increase or decrease the element of statement of cash flows or income statement. Some transactions may affect both statements. Cash transactions means increase or decrease cash account on the balance sheet. Every cash transaction also increase or decrease one of the activities in cash flow statement. and the activities are operating, investing, and financing. Remember, the cash flow statement is just it just shows the flow of cash in and out. So all the cash transactions involve one of the activities that are reported on the cash flow statement: the operating, investing, or financing. Net increase or decrease in cash on the cash flow statement should agree with the ending cash balance shown on the balance sheet. And if they don't match, you have to go back and check your accounting transactions, how they're entered, because it means that there is an accounting error. Stockholders' equity is increased by amounts invested by stockholders, and the account used is capital stock and paid-in capital. Revenues and gains increase stockholder equity. Expenses and losses and dividend paid decrease stockholder equity. The change in retained earning for the period is equal to net income minus dividends or net loss plus dividends. So this retained earning statement has a beginning balance from the previous years, and then for this year you will enter the net income and you will reduce the dividends. And if you have a net loss, then you will enter the net loss and add the dividends. And then you will do your arithmetic, and then you will get the ending balance for the next year, which will be the beginning balance for the next year. Income statement is linked with balance sheet through revenue and expenses, because income statement accounts are temporary accounts and balance sheet accounts are permanent accounts. So the income statement accounts revenues and expenses, they are zeroed out and their balances are transferred to the equity section of balance sheet. Okay. Stockholder equity is equal to capital stock plus retained earnings. And retained earning is increased by revenues and decreased by expenses and dividends. Cash flow is linked with balance sheet with cash. So the link between the cash flow statement and balance sheet is cash. That's a checkpoint to see that our transactions were done accurately. I hope this video will help you to review your material during your exams. This is just a summary. I would recommend that you go and read the chapter 2 on your own. So that's all for this video. I'll see you in the next one. You hope that you have a good time. Goodbye.